Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of how the yield curve impacts your investments in the economy. Consumer behavior and yield curve. The yield curve also plays a role in shaping consumer behavior. Changes in the yield curve impact savings and investment decisions, as well as major purchases like homes and cars. For instance, a flat or inverted yield curve might signal economic uncertainty, prompting consumers to save rather than spend. Consumer confidence, closely tied to yield curve movements, can influence spending patterns and overall economic health. As central banks and policymakers closely monitor yield curve movements, they adjust monetary policies to mitigate risks and support economic stability. Understanding the implications of the yield curve on interest rates, lending practices, investment decisions, and consumer behavior is essential for navigating the complexities of the economy and financial markets. Yield curve strategies for investors. In the world of investment, understanding the yield curve and its implications can be a powerful tool for investors looking to optimize their portfolios. Let's delve into some strategies that savvy investors employ when navigating the yield curve landscape. Yield curve steepening versus flattening trades. When the yield curve steepens or flattens, it can signal shifts in the economic outlook. Investors often adopt different strategies based on these scenarios. Yield curve steepening trades involve betting on longer-term interest rates increasing faster than short-term rates, leading to a steeper curve. On the other hand, yield curve flattening trades anticipate the narrowing of the yield spread between long-term and short-term bonds. The rationale behind these trades lies in predicting economic conditions. Steepening may indicate expectations of economic growth, while flattening could signal economic uncertainty or potential recession. However, it's crucial to note the risks involved. Steepening trades may be profitable during growth periods but pose risks if the economy falters, while flattening trades can lead to losses if the yield curve unexpectedly steepens. Sector rotation based on yield curve signals. Investors can leverage yield curve signals to adjust sector allocations within their portfolios effectively. Different sectors perform better under various yield curve environments. For example, during a steepening yield curve, sectors like financials and industrials tend to outperform, benefiting from rising interest rates and economic expansion. Conversely, defensive sectors like utilities and consumer staples may fare better in a flattening or inverted yield curve environment. By monitoring yield curve signals and understanding sector performance trends, investors can position their portfolios to capitalize on market shifts and enhance potential returns. Duration matching and yield curve risk management. Duration matching is a risk management technique used by investors to align the duration of their bond investments with their investment goals and risk tolerance. By matching the duration of assets and liabilities, investors can mitigate exposure to interest rate fluctuations and yield curve changes. Additionally, adjusting the portfolio's duration based on yield curve expectations can help optimize risk-adjusted returns. Effective yield curve risk management involves diversification and employing strategies like laddering bonds with different maturities, utilizing bond funds with varying durations, or incorporating interest rate derivatives to hedge against adverse moves in the yield curve. By incorporating these strategies, investors can navigate the complexities of the yield curve, capitalize on market trends, and manage risk effectively in their investment portfolios. After exploring the intricate relationship between the yield curve and its effects on the economy, markets, and investment strategies, it is evident that monitoring the yield curve is paramount for making well-informed financial decisions. The yield curve serves as a crucial indicator, offering valuable insights into the state of the economy and potential market trends. Key takeaways. The yield curve acts as a barometer for economic health, reflecting investors' expectations and sentiments about future market conditions. Inverted yield curves, where short-term interest rates exceed long-term rates, often signal impending economic slowdowns or recessions, prompting strategic adjustments in investment portfolios. Conversely, steepening yield curves may indicate economic expansion and present opportunities for capitalizing on favorable market conditions. Understanding the implications of various yield curve shapes and movements is essential for devising effective investment strategies and risk management protocols. Importance of monitoring. Regularly monitoring the yield curve allows investors to stay ahead of market shifts and adjust their investment portfolios proactively. By interpreting yield curve dynamics, investors can anticipate potential economic developments and tailor their asset allocations to mitigate risks and optimize returns. The yield curve serves as a critical tool for forecasting market trends, guiding asset allocation decisions, and identifying opportune moments for strategic financial maneuvers. In conclusion, incorporating the yield curve as a fundamental component of financial analysis empowers investors with valuable insights that can shape their investment decisions and enhance overall portfolio performance. By staying attuned to yield curve movements and their implications, investors can navigate the complex financial landscape with confidence and foresight. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.